So the way the market creates this order block schematic is pretty simple. What they do is they create something a high or a low rather, sorry, a low or a high. When they create this low or high, they know that if price gets to this low in the future, most traders will be looking to sell and put their stop losses below these areas. So what they do is they will sell this market. They will spend their money to sell this market. Why? They will open new positions to sell this market, but they know the money they spend, they will get it back. They will get it back from the liquidity they are going to grab from these traders. So they don't mind spending their money. Then they will still grab liquidity from those traders that are doing what? Selling at breakout. When price break out, those other traders that will be selling, they will not do what? How will they not grab those liquidity? That's how they will not come back to the last area they sold, or they bought rather, the last area they bought, which is this area. So that is how the order block is formed. They sell this market with their money to grab this liquidity from these areas. Then they get the money back that is using selling this market. Then those other traders are looking to break out to sell because price has broken. They will do what? They will now put, all those traders definitely are putting their stop losses around this area, whatever. So the market will decide to like buy so as to grab those stop losses and then go back to the last area they bought, because there they can have a very good discount to sell. They'll be selling at higher prices, making more profit. Now look at the clear example in the chart. We are just like going through it again. The market create this high, right? Market create this high this is for the sell. Let's use the sell example first. The market create this low. What now happened? Created this low, right? Traders will be looking to like sell to buy when price comes back. What did the market do? It broke the low, collect all those stop loss. They use their money to sell this market, to push price back to this area, because they know liquidity are in this area. Traders will be putting their stop losses in this area, so they will spend their money knowing that they will get the money back from those traders that will be putting their stop losses here. Then also those traders that are breakout traders that look to sell when price break a low or a major structure, which is a low now. Then they will now have to buy the market so as to grab those liquidity of those traders or their stop losses, because some will be putting stop loss around this zone, whatever. Make sure they grab those liquidity and go back to the last area they bought, which is the most discounted zone, because there they can sell at higher prices and make more money. If they sold here, it's not as if it's bad, but they will make more money if they push price back so that they can sell at higher prices and make more money. That's why they are coming back. That's why the last opposing candle before the move that broke the low, that's the order block or your demand zone. And we said they has to come back for two reasons. One, to grab liquidity of the traders. Now in this case, the sell side liquidity of those traders that are looking to sell, they have to come back to grab those liquidity. Then two, to buy at discount pricing. For the buy is the same thing. If you know the sell, you know the buy. The market create this high, traders will be looking to sell the market when price comes back to this high, while other traders will be looking to buy when price broke out. So what happened? The market come back. Those traders that are looking to sell, that put their stop loss around these areas, what does the market do? Trade above, collect their liquidity. The market spend its money to buy. He spend its money to do what? To buy, because they know they will get the money they spent in buying, in opening all these positions from the stop losses of those traders at these highs looking to sell. Then also those breakout traders that are buying whenever price break a high or a structural high, which is this high now, they will collect the stop loss by doing what now? By selling the market. By what? Selling the market. Collect those stop loss. So they collect stop loss from both those that are looking to sell, traders that are looking to sell, and traders that are looking to buy. So they collect both sell side liquidity and buy side liquidity. And then they will now have to come back to this zone so that they can, first to grab the stop losses of those traders that will be buying at these areas, and two, so that they can have discount pricing to buy. That's the example again here. The grade is high. Traders will be looking to sell when price gets back to this zone, while some will be looking to buy if it broke out. Now what they do, they spend their money buying this market to this area. They know they will get the money back from the stop losses of these traders. They will get the money back plus profit, mind you, plus profit from the stop losses of these traders that are looking to sell, and also from the stop losses of these traders that are looking to buy at breakout. Now those traders that are looking to buy, what happens? They now have to sell the market to grab those liquidity. So they grab liquidity from the sell side, which is those that are looking to short the market at this structural high, and from the buy side, those that are looking to buy the market when it broke out of the structural high. So they have to move price back to collect those liquidity from the buy side and to buy at discounted prices. So you get more details as you watch this video, as you watch it to the end. So please watch. So for another block to be formed, the market, or this case the big players, which is also the market, has to first grab liquidity from retail traders. Now, what is liquidity? Almost all retail traders or small scale traders trade with what is called stop loss. A stop loss is a price point in the market which traders set as their exit point from a particular trade in case the market is going against them. So if the trade hits their stop loss, they thus lose the money they used in opening the trade to the market. So they lose that money to the market or to the big players. So that's liquidity. So that money that these retail traders lost to the market, or that money the market collect from them, that's what is called liquidity. Now, it is this liquidity grab that makes people lose money in Forex. When you hear that, oh, Forex is a very risky business, people are losing money, it is this liquidity, this money that the big players are collecting from small scale traders. That's what is liquidity. So, and for you to know also, liquidity is grabbed every millisecond in the market. Every millisecond, liquidity is grabbed in one form in every millisecond in this market. So it's a very liquid market, like you know. So why does the market grabs liquidity from retail traders? Liquidity to the Forex market is like fuel to a car. Without it, the market cannot move or function. But why is that? The Forex market, like you know already, is controlled by the big players. These big players need money from small scale traders to enrich themselves. That's why they grab liquidity. These big players, like you know, the Samsung, the Apple, the banks, and the rest that trade this market, they come to this market to make money. That's why they come. So how would they make those money? Is to grab liquidity from the small scale traders. Then another reason for liquidity grab is that without liquidity, the market will crash, or it will not continue to function. It will not function, it will crash. Now why is that so? It's so because if everybody is winning their trade, then there will be no money to pay the winning traders. If everybody is winning their trade, what that means is that for the market to continue to function, some traders must be losing for other traders to win. There must be balance. Now look at this example. Let's say I did my analysis and I see that, oh, this market is going up. Let me buy this stock, for instance. But that same time, another trader is doing his own or our own analysis and saying that, oh no, this stock will drop or this currency will drop. Let me sell. Now that I entered the buy, and let's say the trade really went to my direction, I made money. But at the same time, the other trader was doing what? Selling. But now the market goes against that trader and he lost. Why me that bought, I won. I made money. He lost money. So there must be losing traders to pay winning traders. Everybody cannot be winning in this market. It has to be what? Balanced. That's why liquidity is always grabbed for the market to continue to function. Then another reason liquidity is created, it's to enable the big players to buy at discount or to sell at discount pricing. It enables them to buy and sell at what? Discount pricing. We'll explain this particular one. How liquidity enables them to buy and sell at discount pricing. We explain it in details as we go on. So like we said, you need to know liquidity very well, because if you don't know liquidity very well in the forex market, then you will not be able to know where other blocks are in the forex market. Because like we said before, for another block to be formed, liquidity has to be created and to be grabbed at the same time. So you must know where these liquidity areas are. If not, you will not know where the other blocks are. They work together. The market needs liquidity to create another block. So you must know where these liquidity areas are in the market. So thus far, now you've come to know that it's the big players in the forex market that create and grab liquidity. The question now is, how do they do that? How do they create and grab liquidity? Well, to know how they do this, now let's get to our chart. But simply put, liquidity is resting on each high and each low in the forex market. So now look at our chart to be able to give you practical examples of how the market creates and grab liquidity and thereby creating other blocks. Now, how does the market create liquidity? What the market do is that, like we said, liquidity is resting on each high and each low in the market. We've explained high and low. Now let's talk about high. How liquidity is grabbed on each highs in the market and what other blocks it formed thereafter. Now, if you look at this market, this is a structural example of a high in the market. Something like this. Price is doing this and then reverses. You understand? This is high in the market. So this peak here, this point that it gets to before it reverses, is the high. Good. That's a structural example of a high in the market. Now, if you look at this scenario, let's use it as an example. Price, this was a low, then price moved up. It created this high, which is something like this. Create this high, and then what did it do? If you look at it, it reverses. It what? It reverses. So it has created a high and a low. We are concerned about the high because that's where price went to before it reverses. We'll talk about the low later. Now, what are traders doing? Many traders believe why the market creates this high, because they know many traders believe that since price gets to this area before and it reverses, if it comes there in the future, it's going to reverse. So what they'll be looking to do, since they believe that because it reversed in the past, it's going to reverse in the future. So they will be looking to do what? Sell when the market gets to this price point. So they'll be waiting, and then in the future, now when it comes back to this point, which is around this area, what will they do? They will now be looking to what? Sell the market. Maybe they will now put their stop loss in these areas, wherever, let's say around here. and then they'll be targeting way below or anywhere, but they'll be looking to sell the market. Now this market know that many traders will be trading to this direction when the price gets here because of this high, believing that price will reverse again. So they know where the stop losses are in this market. So what will they do? They will now push price above this area. They know that, okay, since traders are here looking to sell, where will their stop loss likely be? Around all this zone, maybe this area, this area, this area, this area, and the rest. So what they will do, they will push price above it. That was what happened here. You can see when the market gets back to this high, it pushes above it. And now they've collected a lot of stop loss or lot of money from small scale traders, millions that they've collected from these stop losses. You see it now, so that's how liquidity is created. Then there are other kind of traders that only trade when price break a high in the market. Let's say, for example, look at this scenario now. The market created this high and then this low. Some traders will do what? Be waiting for price to get. Let me use an horizontal ray now. Let me put an horizontal ray at this peak in price. Good. The market will be looking to, some other traders will be waiting for the market to come back to this. Sorry about that. They'll be waiting for the market to do what? To come back. Let me use a trend line now. To come back to this area. They will not be looking to sell like the way these first traders was looking to sell. They'll be waiting for the market to break above it. Then they will not be looking to sell. They turn, instead of selling, they will be buying. They are called breakout traders. That's what they are called. They only enter the market when the market breaks a high or a low. In this case, we are talking about the high. Instead of them to sell, they will be waiting for the market to break above it, this high, and then they will be looking to buy the market. Now let's go back to that example so that you see a clear example. Now see what they will be doing. These other traders were selling and put their stop loss above here, right? And then price has broken above it, collect all their stop loss and all their money. Now that these other traders were selling, those other breakout traders that we talk about just now will be looking to what? Buy when price breaks this high. So they will enter the market here to buy. And what will they now do? They will put their stop loss around, let's say, all these zones or this area, because they believe that, oh, the market has broken out of this high, then it's going up, it's going up, it's going up. So what did the market in turn did? It sold back. And what has it successfully done? It has grabbed all their liquidity. You see, it came back and grabbed all their liquidity, which means all their stop losses, all their money. So what has the market successfully achieved? It has grabbed liquidity from those traders that were looking to sell. Let me put it again. I like make my teaching very clear. When the market created this high, good. Those traders that were looking to what? Those traders that were looking for sell, that were selling because the price has gotten to this high and they believe it will reverse. So what the market did, it grabbed all their liquidity here, it stop loss by breaking above their highs. Now those are that kind of traders that were like, when price broke this level, we'll be looking to buy, because if the market break a high, we believe it's going up, up, up. Now they put all their stop loss at this zone. What did the market do? It comes back and grab all their liquidity. So the market has successfully grabbed liquidity from both those that are looking to sell when it came to this high or this area, and those that were looking to buy when it break out of this area. So they have collected money from those who were selling. That's what is called sell side liquidity. That's what they did collect. It's called sell side liquidity. Then those traders that are looking to buy at the breakout, they are called their liquidity grab, all the money they collected, or those kind of, in this scenario, they are called buy side liquidity. So now, where is the order block? The order block is the last. Sorry, let me remove these stuffs from the chart. to make it clear. We'll get back to it later. So the order block is the last opposing candle before this move. Why do we say it's the last opposing candle? It's the last opposing candle before the move that broke this high. Is the what? I repeat, the order blocks in this case, now this is a bullish order block, also known as a demand zone. We talked about that before in our previous videos. Is the last opposing candle before the move that broke structure. What makes it an opposing candle? The move that broke structure is a bullish move. So an opposing candle to bullish move will be a bearish candle. Now, why is it the last? Why do we say the order block is the last candle before the move that broke structure? Like we said, the move that broke structure grabbed liquidity from both those that were looking to sell at this high and those that are looking to buy when the market breaks this high. So that's the move that broke structure. Now, who are the ones that did it? They are the big players. They are the institutions. They are the ones that did it. We know that now. So what they will do now that they've grabbed liquidity, they will come back to that zone to buy. Let's mark this candle. Let's mark this candle. This last opposing candle is our order block. So let's mark it. Good. Now we've marked it. This is our order block. Sorry. So this last candle, let me zoom it clearly. Let me expand it rather. This last opposite candle for the move that broke structure is the order block. We say why? It's simple. Because the move that broke structure, we know it's from the institution, we know it's from the big players. And now see why we say it's the order block. When the market break this high, it has collected the stop losses of all those traders that were looking to short the market or sell the market. Now, the market does not only collect liquidity from from just traders that were selling, they also collect from those that are buying, like we've explained before. For them to collect the liquidity of those that are buying, what they have to do, they have to sell the market. Because let's use this, let's put the buy price to here. Let's say now look at the high, those that were buying. Where would they put their stop loss? We've explained this before, but let's just do it again so that you get the point. They will put their stop loss around all this area, right? In case the market reverses. Now, for the market to grab their liquidity, it has to come back. It has to sell back to grab liquidity from the buying traders, which in this case is called buy side liquidity. So that's why the market has to come back to grab liquidity from those traders that are looking to buy. I don't know if you get it clear. That's why it comes back to the last area. Then to the last opposing candle. Most times it comes back to the last opposing candle before the move that broke structure, so that they can grab all this liquidity from those traders that are looking to buy the market. The another reason it does also it comes back to this last candle is to buy at discounted price. Why do we say it's to buy at discounted price? Good. Now this is a euro dollar chart. So the euro in this case is the base currency, the dollar is the quote currency. Now to get a euro, if price was here, for example, let's use an horizontal ray. Let's say if price was here now, it will cost, you can see the cost it will cost 1 point. This is the cost now. This horizontal ray is the cost. It will cost $1.13274 to get a euro. You understand? But at this area here, let's look how much it will now cost instead to get a euro. Let's look how much it will now cost. Good. At this last candle, Let's look how much it will cost. It will cost just, let me remove this one so that it will not confuse you. It will cost just 1.28. This is the price here, 1.2870, which is lower than this one. So it therefore means they will get it at lower price. It therefore means they will buy at discount pricing at this zone. At this zone, they will get discount pricing. I don't know if it's clear enough. At this zone, they will get discount pricing, because if they buy here now that they broke structure, it's high price, and every businessman wants to buy at discount. Mind you, these big players or the smart money, they are businessmen, good businessmen. So they want to be buying at discount pricing. So for them to buy at discount pricing, they have to come back to the most recent low for them to get discount pricing at that period of time, that given period of time. And the most recent low before the move that broke this structure is this opposing candle, because this was the last selling candle, which means price closed at this level low. So they can get good discount at this zone. That's why they have to come back. You understand? So they are coming back for two reasons. If you remember, the first reason is because they have to collect all the stop losses of those traders that are looking to buy the market. That's the first reason. Then the second reason is so that they can get discount pricing, so that they can buy at cheap price. It's as simple as that. So for a bullish order block now, or a demand zone, the last sell candle before the beginning of the buy candles that broke structure or that break the eye, this is the eye, the last sell candle before the bullish candles that broke this eye, that's the bullish order block, also called a demand zone. So I don't know if that's clear. We believe that is clear enough, or you can still message us if you have further questions. Now we'll discuss about a bullish order block or a demand zone. Now let's go for a supply zone. It's still the same thing but reverse. You just have to reverse the whole example. Now look what the market creates. If the market creates a low, which means, let's use a structural, a skeletal or a structural example of a low. So I'll be able to do it. So what we are saying now, for the low, for the supply zone, for you to know your supply zone or your bearish order blocks, let's look at this example now. The market, this is a structural example of how the market creates a low. It creates, price is coming from this direction, from this high, and gets to here and it reverses. When it reverses, it has created a low. This tip is a low. The lowest point before it reverses is a low. This is the example here. Price created this high up to this point. As you can see, this point, let me zoom a little, expand it a little, this point, and then it reverses. So now many traders believe that, oh, because price reverses in the future, in the past, when it gets here, I'll be looking to what? To buy the market. And now what they will do is they will now put their stop loss maybe around these levels, or this level. Good. Around those levels for their stop loss. Now what did the market do? It came back and grabbed all the liquidity, because it traded above below the low, below the what low. So it grabs all the liquidity of all these traders, grabs all their money. Now the other kind of traders are the ones that only look to sell when price break a low. They believe that if price break a low, I should be selling. You understand? This is an example now. Look at it. They are only looking, what they will do is they will wait. When price gets to that point in the future, when it gets to this area in the future, they will be looking to what? Wait till it break this area. They will be waiting for price to do what? To break this area like this. It must trade below this area. Once they believe that once price break up below the area, it's going to do what? Continue to sell. So those kind of traders in this case, now that price has broken this area, this the most recent low or the low, they'll be looking to what? To now sell the market. And what they will do, they will put their stop loss above. They'll put their stop loss above, and then they'll take profit wherever they want to put it. So what did the market do? It traded back and collected their stop loss. So in this case, it has collected the stop loss of those traders that are looking to sell when it gets back to this low, because they believe it's going to reverse. It's collected their stop loss. Then those that believe that, oh, if the market break this low, if it break this low, it's going to continue selling. What did the market do? It bought and collect all their stop losses. So now for the bearish order block, also called a supply zone, it is the last opposing candle before the move that broke structure. Structure now for a bearish order block or a supply zone is the last low, or the low rather. The low is structure. The last opposite candle means the last buying candle, because this is selling before the start of the selling candles that broke the low. So in this case now, where is the order block? Is this candle that is the order block. This what candle is the order block. And then too, like we said, price has to come back. It's called the order block because price has to come back. Why? Because they will be selling at discounted pricing. It's just exactly the same thing with the buy example we did earlier, but it's just the reverse. Now see the price that they will be able to sell at this area. They will be able to sell at high price, so they will make more money, because here now they can sell this stock. Look at the amount, 1.13. Look at the amount here, 1.13537. So they will have to wait for price to come back to this area, which means they can sell at higher prices. Because if they have sold here, they'll be selling at what? 1.313171, which is small. It's not as if it's bad, but they can get better deal if they wait for price to come back to this area. Then they can make more money, because then they can sell at higher price, make more profit. So that's why this last candle is the what? Order block. In this case, it's supply zone or the bearish order block. So that's what order blocks are. Now, if we go back to the demand order block or the bullish order block, you see that when price came back to this last candle, which is the order block, what happened? Price went up. So those traders that know all the supply and demand zone or order blocks, they will be waiting for price to come back, because they know the market is going to buy. So they will be only be buying at these zones or this area. So the one that bought, you see the money they made. The market did a big push. They made a lot of money. Now the same thing for the sell. Those traders that were waiting here for price to come back to this area, they set their limit here, set their alert, price came back. Then you see what happened when price came back to this zone, which is now the supply zone. You see the movement is sold massively, and they have made a lot of money. So the way the market creates this order block schematic is pretty simple. What they do is they create something, a high or a low, a low or a high. When they create this low or high, they know that if price gets to this low in the future, most traders will be looking to sell and put their stop losses below these areas. So what they do is they will sell this market. They will spend their money to sell this market. Why? They will open new positions to sell this market, but they know the money they spend, they will get it back. They will get it back from the liquidity they are going to grab from these traders. So they don't mind spending their money. Then they will still grab liquidity from those traders that are doing what? Selling at breakout. When price break out, those other traders that will be selling, they will not do what? How will they not grab those liquidity? That's how they will now come back to the last area they sold. or they bought rather, the last area they bought, which is this area. So that is how the other block is what is formed. They sell this market with their money to grab this liquidity from these areas. Then they get the money back that is using selling this market. Then those other traders are looking to break out to sell because price has broken. They will do what? They will now put all those traders definitely are putting their stop losses around this area, this area, this area, whatever. So the market will decide to like buy so as to grab those stop losses and then go back to the last area they bought, because there they can have a very good discount to sell. They'll be selling at higher prices, making more profit. Now look at the clear example in the chart. We are just like going through it again. The market create this high, right? The market create this high. This is for the sell. Let's use the sell example first. The market create this low. What now happened? Created this low, right? Traders will be looking to like sell to buy when price comes back. What did the market do? It broke the low, collect all those stop losses. They use their money to sell this market, to push price back to this area because they know liquidity are in this area. Traders will be putting their stop losses in this area, so they will spend their money knowing that they will get the money back from those traders that will be putting their stop losses here. Then also those traders that are breakout traders that look to sell when price break a low or a major structure, which is a low now. Then they will now have to buy the market so as to grab those liquidity of those traders or their stop losses, because some will be putting stop loss around this zone, whatever. Make sure they grab those liquidity and go back to the last area they bought, which is the most discounted zone, because there they can sell at higher prices and make more money. If they sold there, it's not as if it's bad, but they'll make more money if they push price back so that they can sell at higher prices and make more money. That's why they are coming back. That's why the last opposing candle before the move that broke the low, that's the other block or your demand zone. And we said they has to come back for two reasons. One, to grab liquidity of those the traders. Now in this case, the sell side liquidity of those traders that are looking to sell, they have to come back to grab those liquidity. Then two, to buy at discount pricing. For the buy is the same thing. If you know the sell, you know the buy. The market create this high, traders will be looking to sell the market when price comes back to this high, while other traders will be looking to buy when price broke out. So what happened? The market come back. Those traders that are looking to sell, that put their stop loss around these areas, what does the market do? Trade above, collect their liquidity. The market spend its money to buy. It spend its money to do what? To buy, because they know they will get the money they spent in buying, in opening all these positions from the stop losses of those traders at these highs looking to sell. Then also those breakout traders that are buying whenever price break a high or a structural high, which is this high now, they will collect the stop loss by doing what now? By selling the market. By what? Selling the market. Collect those stop loss. So they collect stop loss from both those that are looking to sell, traders that are looking to sell, and traders that are looking to buy. So they collect both sell side liquidity and buy side liquidity. And then they will now have to come back to this zone so that they can, first to grab the stop losses of those traders that will be buying at these areas, and two, so that they can have discount pricing to buy. That's the example again here. The grade is high. Traders will be looking to sell when price gets back to this zone, while some will be looking to buy if it broke out. Now what they do, they spend their money buying this market to this area. They know they will get the money back from the stop losses of these traders. They will get the money back plus profit, mind you, plus profit from the stop losses of these traders that are looking to sell, and also from the stop losses of these traders that are looking to buy at breakout. Now those traders that are looking to buy, what happened? They now have to sell the market to grab those liquidity. So they grab liquidity from the sell side, which is those that are looking to short the market at this structural high, and from the buy side, those that are looking to buy the market when it broke out of the structural high. So they have to move price back to collect those liquidity from the buy side and to buy at discounted prices. So that is how we explain liquidity in the market. Now, the next video we are going to talk about how to correctly mark your highs and low in the market. Because if you don't know how to mark your highs and low, you will not, because we say for an order block to be formed, price has to break a high in the market. We've talked about to mark a high, but we didn't really deliberate on it. It's tricky. It's a little tricky. So that's what we'll cover in the next video in detail, so that you understand clearly how the market, the highs and lows in the market. Because when you know the highs and low, then you now know that, oh, if you can mark your high and low, you know that price break my high. In this case now, if you can be able to mark your high correctly, you know that price break your high, there's going to be a bullish order block. But if you cannot mark it correctly, rather, you will not be able to do what? Know where the bullish order blocks are. So it's very important to mark your highs and low. That's what we'll discuss in the next video. So please watch that video. And I believe that from this video now you understand clearly what liquidity is. And now you know where those demand zones or supply zones or order blocks are in the market, and now you know why they are formed and how they are formed. So if you have any question, if you are not clear with one or two areas, our Telegram link is in the description. Please message us at any time. I will be so glad to help you out or to assist you. So till next time, take care.